Nicholas Bornos of Capital Link, I would like to welcome you to the crude tankers sector panel discussion. Crude tankers, the tanker sector is, as everybody hopes, the sector about to recover. So we look forward to the great insight of industry leaders who are on this panel. I would like to thank each one of them for joining, and I will let Ben Nolan, the head of Maritime Research at Stifel, who is a moderator, to introduce our panelists. Actually, everybody knows the panelists, but still I will let Ben take over. And again, thank you to all of you for joining us today. Great to have you with us.
Thank you, Nicholas. So I'm not going to belabor the introductions. I'm sure that, as Nicholas said, everybody probably knows both the people and the companies that these people represent. Certainly, if you're dialed into this Zoom call, I'm sure that's the case. But nonetheless, we have, in order of my Zoom screen here, Jeff Pribor from International Seaways, Harry from Tsakos, Lars from Frontline, Hugo from Euronav, and Bob Burke from Ridgebury. So again, representing large, frankly, add all of this together, and it's certainly would be I don't know, top 10, maybe 20% of the global crude tanker fleet. So very powerful group of companies represented here, primarily crude, but there's a few products, and I know that there's a separate product panel, but maybe to the extent that there's some overlap, we'll have some questions there. But with that said, I want to start with a few easy questions, and appreciating that four of the five of you represent public companies. Just in full disclosure, I'm not asking for guidance or anything that your compliance department would have a problem with, but the first question is just a simple yes or no, in your opinion, type question that maybe each of you could answer. Do you think that we're going to have a winter rally in the crude tanker market? Yes or no? Harry, I mean, you want to start with you?
Can I say absolutely?
Yeah, that would be a yes. So we'll, okay. Bob, you're on mute.
What he said. Yeah, I think you can start to feel it coming now. You know, hopefully, well, hope's not a strategy. I think the dynamics point to another few weeks, and we'll be where we hope to be.
Mm-hmm.
Yeah, it starts with recovery. 2 R words. It starts with recovery, and then it'll be a rally. So just wait for it.
Okay, Lars.
Yeah, no, I was quoted in Tradewinds the other day, and you know, sentiment is a strong force, and it's kind of ship owners' perception of the position they're in, and I'm you know, a strong believer that owners, you know, with increased activity we are seeing in the spot market right now, that we are getting closer to some sort of balance where we're actually able to price freight. So yes.
I hate to be similar to the others, but nevertheless, I will be in this case. And I fully agree with Lars that, as a matter of fact, we've not enjoyed a good market for a long time, but it didn't represent the right balance between cargo and the number of ships. In fact, it was more the sentiment that was very negative, because a lot of the cargoes were hidden and done in a private way, which brought the sentiment down. I think that today we are seeing a lot more cargoes, and when I talk to chartering desks, people are a lot more positive, and you can already see the improvement in the rates. So this winter will be a further improvement, and we definitely hope to be where Bob believes we're going to be, i.e. where we want to be, in positive territory.
Yeah, I knew that wasn't going to be a straightforward yes or no answer, but the next one, maybe this will even be more straightforward. Again, we'll get the easy ones out of the way. A year from now, on June the 12th, or sorry, October the 12th, 2022, what would your best guess be for a spot VLCC rate? I think everybody but Bob owns these, and Bob, you know your way around a V pretty well. So a year from now, what do you think? Bob?
Shall I start?
Sure.
Shall I?
You go. Go ahead.
Bob, go ahead. Go ahead, Bob.
We do have 4 Vs that right. Well, and right now they're on charter. Will be exposed to the spot market come end of December. So I think it'll be low 30s, 32, 33,000. That would be where we've all put our money somewhere where our mouth is. So we all have a position.
Right.
Maybe I can go then. I think we'll be higher than that. I think that the fundamentals of the market points to a direction that is probably not more optimistic. I know that October is the start of the good season for us, but I think that next summer will be a lot better than what we had this year. And so I would start with a 4.
Yeah, Ben, I feel the same way. The long-term average for these, can debate what's an average 15 years, 20 years super cycle or not, but it's the high 30s to low 40s, and so I'm with Hugo. I think next year has an excellent chance of being at least a mid-cycle rate, if not better. So I would gravitate towards a 4 in front of the number.
Yeah, I can throw in a little torch there because I had a discussion with some kind of a company close to us, which is in the LNG space, and also even just as close in the dry bulk and coal exposed space. The thing is that we could potentially be drawing very, very hard on inventories here. And inventories is always a look back. It's only half the equation that is kind of more or less real time reported. So we could actually find ourselves, as the LNG expects, that they are in inventory refill throughout the next summer. And if crude is good to follow any of these other kind of asset classes that is are having a raging bull market around us, we could have an atypical kind of year next year, but it's going to be strong, that's for sure.
Yeah.
No, I totally agree with everyone. And Ben, if I was get to ask first, I would say somewhere in the high 40s, but that would be the average. I would expect, especially if we see the levels of scrapping that we have seen recently going to next year, and we have no reason not to believe that this will happen, especially as as scrap prices are at historical lows, and the VLCC fleet, I think 20-30% of that fleet is over. It's kind of aging. Then I expect very strong rates, and potentially within that period that averages 40, we could potentially see a short-term super spike in VL rates in particular routes, especially the long haul or out of the AG to the Far East.
Okay, so we have the 4 public companies all relatively bullish. Bob, I would call low 30s sort of not as bad as we are certainly now, but a little bit muted. What gives you a little bit more pause, let's say, with respect to sort of how you view the world?
Well, I think generally the market doesn't get heated up until a little bit later in the year than October, wherever we are, 12th. I sort of have a mental date of Thanksgiving when things seem to pop, and before then they seem to be a bit lower. But I think also what I'm looking at is ships that are a little bit older, and that's we price our own little market where we sit. But I think the potential for the upside, we all see how these graphs go. Once they go, they take off. Once the market gets squeezed, as we've lived through on the crude side and the clean side, and also people never living through on the bulk and the container side.
Sure. So
I would think once the winter gets going, it could be significantly stronger.
Right. So for you, it's more a matter of timing than necessarily a sentiment that is very different than what other people are seeing.
Yeah, when I look at the numbers, I'm always thinking it's this time of year, but in hindsight, it's always, the fourth quarter and the first quarter that, it's the end of the fourth quarter or in the first quarter to the second quarter that seem to be the highest.
Okay, good. All right. Well,
I think, sorry, Ben, if I can just interject there, I think it's going to be very interesting to see if any spikes in the spot market, in the spot rates in 22 will have any lasting power. I think it's very important to monitor the 1 year TC and how that gets impacted by a firmness in spot rates. So if we see a sustained increase in time charter rates, then we are in for a rally on towards the end of the year.
Right. Okay, that makes sense. So now let's dig in a little bit. We sort of I thought we would start out by level setting just to see if there were any dissenting opinions or whatnot. It seems like everybody's on the same page and feels relatively optimistic, as is sort of the nature of the beast for ship owners. But with respect to the outlook for both an improvement in the near term and then a much stronger year next year and going forward. So let's start with the near term a little bit. One of the things that Lars, you mentioned tangentially was the fact that the LNG market is as strong as it is, and certainly the LNG commodities are strong, and really anything that can burn is in high demand at the moment. How much of sort of your optimism, or how big of a role do you think will or could fuel oil or oil being used for electricity play in the back half of the year, and sort of how much of a winter rally is sort of dependent on that? Any ideas? Any takers?
Well, I think this is like twofold. It's first of all, we've had, and I was even surprised myself when looking at these statistics. It's first half of this year, we've actually haven't really seen that much demand increase in Asia, in particular, and in kind of emerging countries. Most of the demand increase has happened actually in Northwest Europe and US, or Americas, if you want to. So Asia has actually been pausing for almost the first 6 months of the year. But luckily, we expect Asia to come out and to participate in the increased demand in the second half of the year, and particularly now towards Q4 or into the winter. And as you rightfully say, the lowest energy carrier, or the cheapest energy carrier around right now is oil. Kind of based on efficiency into a power plant, the cheapest thing you can get is oil or diesel, which is what you normally would use. This hasn't really been a significant part of the energy space for 10 years. So the big question is how much capacity is out there? How many diesel generators are there to participate in this? We have seen reports of Bangladesh and Pakistan canceling LNG tenders and potentially retendering in the diesel market. We are also seeing diesel cracks rising a lot, and refinery margins obviously rising in the same pattern. So, but this is the big kind of question. So in addition to kind of the recovery case in Asia towards the end of the year, in addition to winter demand, we potentially have somewhere between 500,000 barrels or 2 million barrels. That was what Citibank was guesstimating in some research I saw. So it's an X factor. It's obviously not one. We would all love everybody to make electricity out of water, but in the kind of energy crisis we are right now, this is the case, and then it could be a strong contributing factor. In the old days, in Japan alone, you looked at 1 million barrel incremental demand during the winter months. This was kind of when they used diesel for electricity, but there's big numbers potentially.
Maybe I can add 2 cents to what Lars has just mentioned, and obviously fully agree with all the points that you made about China. And maybe we have a little bit of a different angle there. what we believe has happened is that the sort of flat demand that is coming from China is because of two things. First of all, they had piled up quite a lot of inventories in the oil crisis of last year, and we've seen a lot of excess cargoes going to China. And so obviously no one should believe or could believe the Chinese statistics. So regardless of that, we know that they've played that game, and we know that they've drawn on their inventories. The good news is that they've probably followed the profile of inventory drawdown that we've seen in the West. And then the second thing is that we know for a fact that they are importing oil coming out of Iran, and obviously that's out of the statistics that we're looking at. But we also know that that has a limit, and they've probably reached the limit, the maximum amount of oil that they can import, because they can only import oil to the teapot refineries, the very small refineries, as the other ones are. Do belong to large corporates, Chinese corporates that have assets to or in the US, and therefore exposed to the US sanctions. So I think that on both cases, I fully agree with Lars that we should see an improvement in the imports of oil, particularly from China during this winter.
I think, go ahead, Jeff, then I'll go.
Well, I was just going to say, this is the discussion from Lars and Hugo both underscores the importance of inventories. In my discussions with investors, I find that is not talked about quite enough. And we talk a lot about oil demand, but for us, it's obviously about demand for tankers, and sometimes that's for storage, like last year. But this year, it's the other side of the coin. And one of the frustrations is that the inventory numbers in China, of course, are opaque. So we have to kind of infer or make educated guesses, as Hugo just did. But to me, it's very clear that OPEC is really laser focused on this, and that's what's behind their very measured approach to letting production come back. But all signs point to the inventories being at a level where OPEC production is going to have to follow the increased demand seasonally, cyclical recovery from the COVID crisis, and the extra for fuel oil for gas replacements.
I think even with the price of gas, what I found is with the price of gas so high in Europe, ironically, the carbon credit mechanism and pricing mechanism actually acts as a dampening effect for to allow coal or oil to replace gas as easily as you would think. So most of the demand will come from Asia or the States. I was around in Europe and New York the past couple of weeks, London actually, and I sat with maybe 5 or 6 different oil companies or traders, and we've all read the same thing. And even at over a cup of coffee, which is refreshing to do as opposed to a Zoom, they all come up with between 650 and $1.5 million. And that was a couple of weeks ago of crowding out or replacement. Mm-hmm. And the numbers I've seen have consistently gone up, little by little as time goes by. So it's cold. I tell my kids they have to pray for a cold winter, not good grades.
Well, yeah, we might have overlapped in London. It was great to use my passport again, doing my part to help the crude tanker market. But that's helpful, and certainly framing in and some of those data points are interesting. I want to go back, and there's a lot of different things that we can talk about, but let's go back to something that Hugo mentioned, and has sort of been, especially for you guys, Hugo and Euronav, one of sort of the more marquee talking points, this ghost fleet, right, of tankers that are moving oil from Iran, despite sanctions, to China. First of all, maybe Hugo, we could get you to frame it in, but let's talk a little bit about sort of how this unwinds, when it unwinds, and what impact it might have on the tanker market.
I mean, I'm just going to take 1 minute, because quite frankly, I don't really care about the sort of ghost fleet, simply because what we are missing are the barrels that they transport. So it's not about the ships, it's about the cargoes. The ships, if and when there would be a relaxation of the sanctions, I believe that those ships will never come back to the market. So in fact, today the market is a two-tier market. You have this ghost fleet, if you want to call it, and it's probably a ghost fleet because it's poorly managed, very old vessels, poorly manned, not insured, very dangerous, very risky, all the rest of it. And it's anywhere between 55 and 80 ships, so it's a significant amount of ships that have been doing that for maybe last 18 months. And then you have the regular fleet, the international fleet that is exposed to all the other cargoes that we know, and all the improvement on the cargo front. So the demand for transportation is coming on our side. It's obviously not coming on that side because of the reason that I mentioned. If the sanction would be lifted, that fleet would not come back for a number of reasons. It's not a good fleet. I mean, it's a very old fleet. It's extremely poorly maintained. It's out of surveys. It's mostly trading outside the regulatory framework that is very strict in our markets, believe it or not. And to bring back such a type of ship in the market would be useless. At the same time, those guys will have an opportunity to scrap. Scrap price are still very, very high. So I think that the temptation to bring them back into the market would simply be replaced by the very elevated scrap price, meaning that a VLCC today you're fetching 20, 21, 22 million. So it's a very, very nice number.
Anybody else care to talk about Iran a little bit?
Yeah, I'm you know, obviously I can echo what Hugo is talking about here, but I think one thing that's puzzled me over the last couple of weeks is we've actually seen floating storage increase in certain regions of the world. There is absolutely no economic sense whatsoever in storing oil in a backwardated market unless you're doing a massive punt on flat price. And people do that to a very limited extent. And it's Southeast Asia is one of the regions that's growing. And mind you, all barrels, you know, regardless of whether if it's fuel, crude, you know, diesel, whatever, is in backwardation. So it becomes less worth in a month. And still you have inventory growing. So I think actually that could potentially be a good sign, because I think the barrels are probably difficult to place. So basically, and most likely due to origin. So it could be that we're already witnessing kind of the limitations to this trade, as there are maybe not that aggressive takers any longer for these molecules that have a kind of a funny origin.
I think the current administration is under a lot of pressure in a lot of areas, and the popularity and poll numbers have come down significantly over the past 6 weeks. So my own guess, I don't think it would make any sense for them to take on something else controversial at this point in their development. Even if they lose just a few points of popularity, they're already in a bad position. So from a political point of view, there's not a lot of upside.
I don't know. Might take the other side of that one. I was going to say the same thing. Look to Washington, whether it's good or bad. I think if they see a win, which defined by this administration coming to an agreement, coming to terms with Iran, might be considered a win from their perspective, because Biden supported the nuclear treaty when he was vice president. So, you know, just I think either way, it's kind of not a market fundamental. It's a political fundamental. But look to Washington over the next couple of months, and we'll see.
I agree, it's political fundamental, and if you're at the cocktail party tonight, Jeff, we can discuss.
Well, that's no. We want various opinions here, so feel free to lob out, you know, your expectations as to sort of political developments or whatever. It makes for good television here, but
a certain percentage of people will not like it,
yeah. And
if you're already on the ropes, you don't want to lose anyone, even if it's popular with a huge percentage. You know, you're playing the margins. Then you're not swinging for the fences, as we say.
Sure.
So it's just a guess. I'm not a politician for a lot of reasons, and that's one of them.
Well, there is a question that came in from the lines here or Zoom or whatever, but I'm going to tie it into, well, maybe I'll start with my own little question and tie in this other one's, but you know, we talk about Iran and you know, we haven't, but certainly one of the big catalysts is OPEC gradually increasing, or maybe not gradually increasing their production. But I think from my perspective, one of the potential drivers for the crude tanker market is in increased activity level in the United States as oil and gas prices are higher, and as a function of that, the rig count's moving up, and the U.S. quickly became a major player in the export of crude oil. As you guys are looking at it again, how important are those U.S. barrels and incremental U.S. barrels to a tightening market, and with respect to your view that next year is going to be pretty good, which is sort of universally held here?
Well, in an ideal world, all the oil should come from US, and China should be the only consumer. No, the US volumes are important. We like to think that there is between 37 and 40 million barrels of crude oil hitting the waters at any point in time in a normalized year, maybe north of 40 even. And then, US export numbers of 2 to 3 to 3.5, 4 million barrels is significant to the to the ton miles. And ideally, we don't want the US to import very much either, because then you make like a perfect kind of ineffective round voyage.
Yeah, and the thing we all hear all the time, especially the last few weeks, given the shortage of gas, is that overall, fossil fuels have been underinvested globally, but especially in the U.S., given the capital markets distaste for public companies investing too much. But that's the negative side, or the glass half empty. Glass half full is, I heard this yesterday, I hope it's right, that about 50% of the U.S. oil production is in the hands of private companies that are privately owned. And I think there's a tremendous opportunity for them to make a lot of money investing in shale oil, which can ramp up production much faster. Look at Saudi Arabia is going up 1 million barrels. It's going to take them 3 years to do it. So if we're going to get more oil to meet the shortage that is showing up now, it's going to have to come from places like the U.S. And I think it's going to come from private capital. And I'm relatively optimistic that it'll be higher than most people have been projecting till now.
So this leads to the question that came in, and I have my own opinion here, but it's not about my opinion. The question is, there, I guess, is some noise that Biden might reinstate the ban on U.S. exports of oil. What are your thoughts on the, I don't know, let's not call it the likelihood, but the potential ramifications if that were to happen?
I just want to address one thing about oil production. There is virtually no capital coming into the private equity funds who raise money for energy. It's just not there for all the reasons that we know, and Jeff said that the public doesn't want to hear about it. But I also wanted to add that the U.S. is an inefficient exporter of oil. We don't have the deep water ports yet that we need to sustain 3-4 million barrels a day, and we're just doing it now. We'll have one VL port shortly, and the rest is in reverse lightering. So it's inefficient for the entire system, and it's the furthest destination from China. So as I think Lars said, if all the barrels came from the U.S., that'd be ideal.
It's coming quick though, Bob. I think Hugo might disagree with you. I noticed his VLCC is loading almost every day in Corpus Christi. Yeah,
Corpus, I think, yeah, but that's about the only place. And if we're going to do 4 million barrels a day, it's going to take more than that.
No, absolutely. And I think that let's not get carried away. Of course, we all want the perfect world, but quite frankly, we already have a lot of perfect fundamentals. So if you add to that one, then maybe it's going to be a crisis, booming market, but the market will be so high that it will hit demand for once. Now, seriously, I think that we had good exports before the COVID crisis, and those good exports were anywhere between 1.2 and 1.5 million barrels. Today, there are negligible quantities. If you eliminate the Suezmax going to Canada and really look at the export, sort of long distance export, either to Europe or to China. What people often don't talk about is the increase exports out of Brazil. we're doing more and more of those, and quite frankly, that's equal distance to China as if you leave from the US, or almost. I mean, give it a couple of days less. And I think that we believe in, and when we talk to Petrobras and the likes, that they are still capable of raising the production. We also talked to a number of people, oil majors, Total, but also the American Exxon, etc. There is still a number of offshore projects out in the Atlantic. The one that I'm going to mention is in Guyana, and that is deemed to export 1 million barrel by 2023. But it's a ramp up, and so in 22 they will have more exports. The field is already in operation, and then by 23 they should arrive to their goal of 1 million barrels. So there are a lot of sort of long distance ramping up production that will help the market, and we are not dependent on the US. It is obvious that we prefer the US to be able to export. We prefer the US to produce more for export. But I don't believe that we are dependent on the US for a recovery in the market.
Great. So there's a few questions here. I'm trying to sift through them a little bit, but one of the ones that I get a lot is, again, sort of the crossover between products and crude, and not necessarily can one work without the other, but conceptually you hear about refineries closing down and wherever in consuming regions, and new refineries opening up in places like Saudi Arabia, and it would seem as though a portion of the crude tanker market's being cannibalized by the product tanker market. How big of a concern is that? Is that enough to sort of derail a crude tanker recovery in favor of a product tanker recovery, or is it next question, let's just move on, it's irrelevant?
Maybe I'll start, because I believe that we are the only one pure player, sort of crude only in this panel. So I started my career at Euronav 16 years ago, and the very first day I heard exactly the same story. And I heard it over and over and over again. It's either that or pipelines are going to replace ships. I do believe that people are building refineries not close to the production, but close to the consumer. And that's the primary reason why they're building refineries. So overall, you do need to shift a lot of crude oil, and it's a crude mix. So when you're building a refinery, let's say in the Middle East, you can normally not, and more often than not, you're not only refining the crude that you produce locally. You like to have a mix, and that's what makes the margin. It's even more true for the refineries outside the Middle East, and certainly the one in the US, the one in China, the one in India. I mean, they like to have a product mix, because you have 56 different type of crude oil, and all of them can provide you advantages or disadvantages according to your refinery programs and what products you want to produce. So I think that we shouldn't get carried away. And it is true that there is somewhat of a correlation, but the correlation is more of a ceiling. When the crude market is not doing well, I've never seen the product market doing well for a long period of time.
Right. Okay, good. Fair enough. We'll move on. So the other question that I get oftentimes is people saying, you know, all I hear about is how bad the tanker market is, but nobody seems to be scrapping, until lately with that caveat. And this question came in from the line. What has been holding people back from getting rid of ships? And I think it, at least in part, goes back to the earlier conversation, but and when should we start to see, you know, some removals in earnest?
Well, it's if I can just start there, it's because I have this question many times today as well, and it makes absolutely no sense whatsoever that we're not scrapping. So it means that you know, there is something funny going on out there, and I don't believe it's owners' expectation of a raging bull market, because owners normally don't have that kind of patience, and I don't prepare to put a 20-year-old vessel through class paying $3 to $4 million and all that stuff. You know, I think it's a combination of, number one is obviously the possibilities of making large sums of money transporting sanctioned crude. Secondly, we have had COVID in kind of the key recycling countries and recycling sites globally. So capacity has been an issue, and efficiency has been an issue for them. And thirdly, during the pandemic, a lot of ships were getting extensions in order to trade, basically because yard capacity wasn't there to do the dry docking. I don't think that's much an effect any longer because they were not really given for that long duration. But there are a few kind of factors that come together. Which one is the strongest, I believe, is the alternative use for the vessels. And being that, you know, both Hugo and ourselves have looked at kind of how many vessels in the fleet on the VLCC side are, you know, having funny trading patterns and, you know, don't clear anybody's KYC process. And that number is staggering. You know, you're talking close to 40, maybe even 50 vessels. So it's, so I think that's the biggest factor.
And I think don't overestimate the fact that asset prices, values have been rising over the last, you know, since the summer, when the market, the freight market, did not justify such, you know, such an uptick. And I think owners, yes, they didn't expect the freight market to justify them keeping the vessels, but they were seeing this trend of asset prices at least stabilizing and going up, you know, 5%, 10%, and they were kind of hoping that they can achieve a much higher price than scrapping the vessels at whatever $400 that was the lightweight at that point. Today, we have seen, even though we have seen asset prices firming even more than the summer, and we're looking today at about 15% to what we had, you know, during the summer period a few months ago. At $600 per lightweight, I think it's enticing. One, you know, an owner with an, you know, an old vessel, you just cannot overlook a $600 per lightweight ton. It's not very often that you get these kind of levels, and with all the environmental impacts that are coming, you know, that you have to face over the coming years, you know, you take the money and run and call it a day. So I think this is what kind of enticed owners to press the trigger and scrap.
Great. So let's move to, well, I sort of want to fit this one in. This came from the line. Basically, the question is, you know, it seems all that we need to do is for a better market is just for nobody to order for a little while. And why can't tanker owners just sort of collude and decide to not place any orders for until 2026, like OPEC colludes on oil production? I would say be careful that remember that you're public. I'm sure you all know, with the exception of Bob. But just rough thoughts on that.
Who's this guy work for who's asking this question?
I think antitrust rules apply to Bob too. So
yeah.
As he's well aware.
Yeah.
Yeah. So,
no, that's a silly question. That's just a silly question.
It sort of is. But
you know,
that said, Bob, I think we've all been around long enough to know that sometimes many owners will telegraph what they want other people to do, right? And so if they have an opportunity to sort of communicate to the market in a public forum, they will encourage people to do things that maybe they're not even thinking to do themselves, right? But
it's especially in a bad market, this comes up. I mean, people who are caught colluding or price fixing, it's always when the market's bad. Right. And when the market's good, it doesn't go there. And the defense is we're losing the money anyway, so we weren't really colluding, but that's not true. And, you know, I've shared this before. It's a tragedy of the commons that, you know, the marginal benefit for me putting one more sheep on the commons in the village when there are 100 sheep and 100 people is, you know, my marginal benefit's 100%. The problem is everyone else sees that and everyone else does it, and then it all goes to hell. So, it's just the nature of how business works. Everyone prices their marginal ship out and discounts what it does to the rest of the fleet because they have a disproportionately small piece of the fleet that it discounts that negative effect on. So, as long as there are more than 3-4 players, it's going to work that way. It's the same thing in the airline business. The airline business beat their brains out for decades and had negative equity until they had frequent flyer miles. Frequent flyer miles are the only things that had any customer loyalty. It wasn't reducing prices because the next guy would. It wasn't buying newer planes. It wasn't having more routes. It was just frequent flyer miles. So there's no stickiness. We sell a commodity.
Yeah, but I'll throw in a counterpoint to that, Bob, since I guess you and I are going to have to settle this over a cocktail later. But yeah, we all know that example, and it is what we worry about. That can, all things be equal, create a tanker cycle. But there is a case for the larger companies, and maybe I'm talking the book of everybody on this panel pretty much. But if you have a certain size fleet and you're to have well-developed relationships with major customers, then to be looking at some sensible new building for a certain percentage of your fleet renewal program, which in our case was the dual fuel, but I know everybody here has done some new buildings tied in with customers. So that is different than the craziness of a completely speculative market where someone's ordering new buildings just because they hope that they'll be able to take advantage of that in the pure spot market and nothing else. So there's kind of new building and new building, I would say.
And I think it's very important since we are the company that we have publicly stated, and Mitch Tsakos has been vocal during his Intertanko days, not to order speculatively. And over the last few years, we have strategically put vessels on order. But it's on Jeff's point. It's very important to know that the cargo that it's supposed to go on those new buildings.
Yeah, but I don't think it matters. I don't think it matters if the cargo. It's all moving oil. I mean, the world demands so many ton miles moved a year, right?
It's moving oil, but for example, the Equinors of the world or the Chevrons will not transport, will not charter a vessel that it's an older vessel that wanted a new building. So we had to go out and build 9 Aframaxes for Statoil at the time, only because Statoil did not want to transport that oil in second-hand tonnage. Recently, the same with our dual fuel Aframax that we ordered. Again, long-term contracts on supposedly to go on vessels that the charter does not want to charge to put on second-hand vessels. So it's kind of I know it's kind of an oxymoron, but in the end of the day, it's very important to differentiate between speculative buying and strategic contractual agreements. A speculative buying that will start encroaching on other people's cargoes and create downward pressure. Whereas we feel, and we have seen it, that building against long-term contracts, not just for a year or two, but 5 to 7, potentially to 10 years, does not impact the equation. It's just the nature of the beast. That oil would not go anywhere else other than new buildings.
Harry, so I'm going to have to. Sorry, go ahead, Lars.
No, I just want to kind of circle back to the collusion point. I don't think we as ship owners need to collude on anything. Because I looked up this today, and by 2025, just for the VLCC fleet, and mind you, the order book is 80 vessels or thereabout. By 2025, 183 VLCCs will have passed 20 years. And we all know how easy or difficult it is to trade a 20-year plus tanker, and particularly with the regulations coming in on energy efficiency, carbon exposure and so forth. So I don't think we need to collude anything, because to be quite honest, I think we'll struggle to actually find yard space to order the tonnage that we might need over the next few years.
Yeah, Hugo, I think you were against my point, right?
Yeah. Sorry.
Were you against my
No,
the
no.
point I
In
was
fact, I was I was going to say exactly the same. I was going to
okay.
say whether I agree with you or with Bob doesn't matter, because when I looked at exactly the same picture as Lars pointed out, and he made the 2 points that are the most important points to me for the coming years is: one, the order book today is very thin. Secondly, the order book tomorrow cannot grow crazy
That's the point.
as we were talking about, simply because it's full of other type of orders. I mean, containers, the LNG, dry bulkers, and it is a fact, and you cannot just create more space. You can be a little bit more efficient. I'm sure that if you really scratch or if you really push the yards, you're going to find some berth in 24, but the vast majority will be 25 and beyond. And we are still waiting for a wave of orders coming from the LNG and a third wave of orders coming from the container world. So I think that our market is protected just by the other markets, the other shipping markets.
This is an extremely important point that both you and Lars mentioned, and I think investors or whoever listens and follows the tanker panel needs to understand, and this needs to be ingrained in their mind when they look into the tanker sector. The capacity, the supply is set. Today, we are, even if we overorder today, you will not get your vessels before, absolute earliest end of 23, if you're lucky. Otherwise, you're looking into in 24. So all of us, we could be faced in a negative growth environment for at least the larger vessels, the VLs, the Suezmaxes, and possibly the Aframaxes, with 30%, close to 30% of the fleet over 15 years of age in a historical low order book. Over that 2-3 year period, we could be faced in a situation where there will not be enough vessels to carry the increased oil demand that we're seeing. That the majority of that will need to be carried by vessels. So this is very important. The runway that we have of 2-3 year runway should not be underestimated.
Yeah, like Hugo said, since the day I started in shipping, I've heard there's no more yard space. But this time I do believe it, because I see what's happening on the container side. I see that the yards are changing berths from tankers to containers. I see the pricing, even in China, for Suez are over 70 and V's are 110. So the pricing is squeezing us out, because we certainly can't afford that now. And the delivery isn't for 3 years. So I think that is and generally I also feel if you're looking at the order book, then you're really desperate. But I think in this, right, I mean, the order book is far out. We always like to look at that as a positive sign. But I think in this case, with the dynamics we have with what's going to happen over the next year, the order book is only going to continue the party going. So that would be
and also, if I can add to that, finance is not readily available for everyone to go out and speculatively order any tanker. Just a handful of companies, I guess all of us in this panel, fingers crossed, do have the axe to capital. But for every Tom, Dick, and Harry to go out and order speculatively to play the market, I don't think that they can do that anymore. That was the case back in the in the heydays of 2004, 5, 6. But I think that the party's over on that.
And private equity isn't there to back up the debt, so that's gone. It was a combination, right?
Well, that question got a lot more play than I thought it would. And we are almost out of time, and I have more, but I've already been given the nod here. So I'll finish with the one that I almost always have asked for, gosh, I don't know, however 15 years, however long I've been doing this, these panels. Somebody gives you $100 million and says, go, invest in a tanker or a tanker equity, or just hold the cash and wait until you think it's a good time. What do you do with $100 million today? And we'll just go around the horn really quick, because I know we're out of time. So maybe Jeff.
Yeah, well, the question I want to answer is, maybe I'll shoehorn into that, is I think that in the next 2 years that we're going to have an old-fashioned rally that you could make money with that $100 million and anywhere you'd invest it. But if you want that money to be returned to $500 million in the long run, I'd put it with a tanker owner, which I think would be any of the ones on this panel that is large enough to be close to the customers and evolving to the energy transition and beyond. So short term, anywhere you want. Long term, companies like those, they're sitting here today.
I would avoid probably investing in a real asset today with possibly semi-inflated prices. But as Jeff said, any of the companies except Bob's, unfortunately.
Are you going to invest in Bob?
I'll let you invest, Harry. You can give us a few bucks.
You can invest in Bob, but in a different kind of manner. You can buy, the majority or all of us are trading at huge discounts to NAV. Hopefully, the market, our valuations will recalibrate back to the norm, and through that, I think people can make, a decent amount of money.
Okay, it looks like Nicholas is there. Just one word answers for the last three.
Okay. Well, I suppose that I will put it in Euronav because I would follow the move of John Frederickson.
I buy 10 to 15-year-old Suez and Vs.
I thought you were going to say you were going to buy 10. 10 or 20, you need to bring it back.
$100 million will take you, you just go to the bank and lend another 200 million, and then you buy some assets. So it's or shares.
I think shares are better than assets.
Great.
That's what we are here to sell.
I think I have all you in my PA.
Well, thank you to everybody. I think we have come now to the end of this very spirited and insightful discussion. So really, thank you to all. Thank you, Ben, and to each one of you. Great panel.
Thank you very much.
Thank you very
We're
much.
all waiting for the recovery to knock on our door.
That's right. Last Zoom panel right here.
That's it.
Fingers crossed.
Jeff, see you later. Hope to see you too, Ben.
Thank you.
Bye, everyone. Take care. Bye-bye.
Bye.
Bye.